Each generation has a different approach to money, savings, retirement, and what it means to be financially free and secure. So, strategies for starting on that journey can vary quite a bit, and Gen Z is no exception. That's why in this episode of the podcast, I talked with Jack Campbell, an investor and venture capitalist who helps Gen Zers to discuss how they can map out and navigate their path to financial freedom. Well, my guest today is Jack Campbell, who is on a mission to rewrite how Gen Z thinks about money. A former Marine captain turned investor, venture capitalist, and CIO, Jack built his fortune not through luck or hype, but through a conviction, logic, and the kind of discipline forged in the military. After a brief stint at Goldman Sachs, he saw firsthand how the financial system was never built for people under 40. While Gen Z was being sold crypto dreams and outdated advice, he saw something else, a world in transition filled with asymmetric opportunities that were that few were taught to recognize. Jack helps young people cut through the noise and approach wealth with focus, patience, and strategic conviction. His upcoming book, Crash Course, shows how to turn global disruption into generational advantage and finally build wealth that lasts. Welcome to the show, Jack.
Hey, what's going on, Steven? How are you?
All right. So we were talking before I hit record about an episode I did a while back, episode 204, in which I talked about a guy who helps millennials invest. So your concentration is for the next one in line, Gen Z. So
Yeah.
I guess my first question is, how does a person's generation define one's financial goals and saving strategy such that there are people actually specialize in this? And what is
Right.
that definition for Gen Z?
Great question. Yeah. I mean, so generations, there's definitely some blends here. If we're going off of what the Pew Research says, it would be, I think, 1997 to think 2012 would technically be Gen Z. But I mean, there's some wash here. It could be 2000, but we think of them kind of as general broad categories. In respect to why it's different for each is the life cycle goals are different. For millennials, they primarily have kids now. They've been, buying houses at a later rate than prior generations, but now they're buying homes. And so their macro viewpoint on their personal financials is substantially different than someone who's 22 years old, just graduated college, in kind of a tough job market, maybe went through college while COVID was going on, so had some social issues there when it comes to hiring, things of that nature. So that would be kind of the way that we'd think about it. But yeah, I mean, this stuff is still applicable to a millennial. It's just kind of where they're at in their life cycle. Even Gen Z, some of them now, or Gen X, yeah, I guess in theory. But yeah, people's financial goals change as they age. This is the final point. So
And it's somewhat
yeah.
behavioral, as you said, their outlook
Mhm.
on life and things like that. So they
Correct.
have, but you say that there's a different mindset about money that
Yeah.
goes with those generations?
Correct. Absolutely. I mean, I think, if we're going to go back to the baby boomers, they come online pretty heavily in the early 70s. And, it was actually hard. There was a lot of baby boomers at that point competing in the job market. And that was rough for them. They started to kind of kick in heavy on asset appreciation through the 80s. And obviously were hit a little hard at the '08 crash, but generally have done probably as well as any generation has in the US in recent history on the averages, right? This is just on the averages. As for the Gen Z though, and millennials, they're on the other side of it. They're hitting the market. 08, 09 is on the front end, and they're coming into a macroeconomic turmoil. So they're often very skittish when it came to equity investing over the last 10, 15 years. As for the Gen Z, this is, their first real exposure was COVID 2020, 2021. And I think a lot of the issues arise is, they watch, Roaring Kitty was a guy who was popular on doing the long call on GameStop, and he made, $30+ million, if not more. And also just the crypto hype, which has been, these meme coins, derivatives from Bitcoin. And I think that has created kind of a gambling mentality, as in the financial world, we call it a speculative mentality. as opposed to actual investing. And I think that's where a lot of the younger people are kind of lost. You had what was skittishness in the millennials. We see actual risk on approach into more of a gambling type attitude
Mhm.
with the Gen Z, would be kind of the way that we think about it. Yeah. So,
Well, a lot has changed. I mean, speaking as a baby boomer myself, uh, getting married in the late '80s and
hmm
graduating college in the early '80s, uh,
right.
there wasn't as much information out there as far as investing and how to get into it and things like that. I think index funds and even mutual funds were sort of a new thing, at least from what we understood.
Absolutely.
Being out there,
Yeah.
there was a lot more. Oh, you look in the Wall Street Journal, and this stock is doing this, and that stock is doing that, and the function was more on, and the focus was more on, you know, investment in individual stocks. You have a stock portfolio, and the
Right.
idea of a mutual fund that looks at a particular sector or a particular index and mirrors that and creates, it spreads the risk and there's some diversity depending on how the fund is defined. But that was all new to us. Back to then it was, oh,
Absolutely.
you get into an annuity or you put into maybe a 401k if you have one. My wife was a federal employee, so she had the
Right.
traditional pension and 401k. But learning that and getting started, we didn't really get started in investing probably until the early to mid '90s. Really, we
That's a
got a
really
late
good point.
start.
Yeah. The barriers to entry for y'all were, pretty substantial because you would have to have someone you're calling. You have your stockbroker. They're placing the orders for you. As soon as it kind of became more electric, meaning that we actually had an ability to spot fill your own things for you. Yeah, I think the early 90s would be where that was at. And those that in the, baby boomer generation that had exposures, they were generally in New York or high net worth individuals at the time that had their own guys doing it for them. So, you're right. Actually, when it comes to access to the average person or just anybody, it probably was, yeah, early '90s. So that's a good point.
And also
And
to
I
do
think
it, the do it yourself that you have now. You can go on,
right,
where my wife and I are in Vanguard because her father was heavily invested in Vanguard. And you
yeah,
can go on the Vanguard site and you can tie it to your bank account and you can buy shares in a mutual fund. There's a scene in, I believe it's The Wolf of Wall Street, where uh, uh, Jordan Belfort starts working for this big firm, and he
right.
showed this is how we do it. Then we write up the stock order, we put it in this container, we stick it in this pneumatic tube, and it gets sent off to
It's sent off.
buy on the floor of the stock market. And now you can do
Right.
these instantaneous trades. It really is sort of democratized investing
Absolutely.
now as
And
opposed to the boomers.
you're absolutely right, and I think that would be, as just a general comment on this, I think for the Gen Z is opening up those brokerage accounts, maxing out your IRAs. Those should be kind of the first things that we should be doing right now, because to your point, access to these instruments. It's Vanguard, it's Schwab, Fidelity, E Trade. I mean, it's not that difficult to set up. It's just people aren't doing it, and I think having exposures earlier on
Mm-hmm.
is really where we're going to see a lot of that compound effects down chain. And you have a couple $1 million, if not more, nest egg, depending on how early you start. So that's a very good point. And when it comes to do it yourself,
Mm-hmm.
kicking in at that point. So yeah, but yeah, that'll be my comment on that.
And the
So,
earlier you start, obviously, the better. And
correct.
I've always said that if your company has a 401k with matching funds, that's the first place to go because the
Absolutely.
matching funds, that's instant money. That's 100% return on investment immediately.
Right.
And you can even make it either traditional or Roth. You have even more options now with a 401k uh, as far as the tax implications of it early on.
Absolutely. Yeah. With the Roths now, especially, I think, and what to me is the most interesting thing, but also the most scary thing about this is if someone's starting doing this at 21 years old, they're, even if they're just doing the S&P 500, which I don't, I think it's a good place to start, but that's not where I live. If they just did that, they might be, we're talking retirements of $8 or $9 million,
Mm-hmm.
assuming we stay at that 7 to 9%. If they start at 30, we're looking at 4 million. So even that 10-year window, it's just if you were contributing earlier on, that that compound value is just it really hits that exponential curve. So starting, as early as possible is really the goal. I mean, I would, recommend if you're 18 and you can open an account, I'd start it then, as opposed to trying to play catch up at 35 or something of that nature. So
So
that is, I think, kind of why we're in this window with Gen Z, millennials, obviously, and it's the problem with this. We're talking about money. It's a very personal thing for everybody. What's your number? What lifestyle do you live? And I think, and that's kind of where I think a lot of people get caught up on. And the reality is it's just being overweight U.S. large cap companies generally will be, and this is very Warren Buffett-y, but I think that would be the place for people just to start. I don't live there, and we can get more into my strategies here in a bit, but that would be better than doing nothing, right? So
mhm.
I think that's really the view here. Obviously, this isn't official financial advice, but you know what I mean. Just
Well,
generally
yeah,
speaking,
yeah.
good place to
Generally
begin.
speaking,
So,
and which kind of nice segue into it, the general the disclaimer. Folks, as I'm sure the listeners have figured out, but it's always good to say,
yeah,
look,
it's good to
we're
say.
chatting here about ideas, but you really need to talk to a financial professional about what's right for you. Don't go doing stuff and investing and spending your money or investing your money based on what we're chatting about here. So,
Yeah,
but it's
exactly.
before we go down to the next step, we talk about where
Yeah,
you are. But you're in your 20s, you're out of college, you got your first
right,
job, and you're in your 401k with the matching funds. The traditional stuff is a good place to start, and you need to create this baseline
right,
because in your 20s, because of how long you have for it to grow, you don't have to invest as much as if you waited until your 30s. And also, you have more risk tolerance because you don't need the money for another 40 years. So
right,
that helps. So you can start with the traditional stuff, the basic stuff, but then you move on to other things, and that's where our discussion begins. You
right.
indicated the old money rules don't really work with Gen Z, and why is that? Why don't they work with Gen Z?
Yeah. So there's really good. Yeah, it's a great question. There's really two ways that I think we need to think about this. I'll start with the macro environment that we're in now versus prior generations, which I think is something that there's a few people talking about it, but not nearly at the level we should be. And I have to get a little historical here, so bear with me. But in 1944, we set up the Bretton Woods Conference. It was nearing the end of World War II, and the whole world order was set up at that point for the U.S. is patrolling the seas. And by the way, I'm bringing this all back to where we're at now. But the U.S. is patrolling the seas. Have basically the start of what turned into globalization, and so hyper specializations across countries, supply chains on complicated goods are touching 20, 30 different countries. To make this end product. And I think where we are now in 2026 is and this is a geopolitical comment, but we're seeing some breaks of these orders starting to occur. We saw obviously what happened in Venezuela. We're seeing the Houthis firing on cargo ships out in the Red Sea, potential Chinese invasion of Taiwan. I mean, and obviously the Russian landmass invasion of Ukraine, first one since World War II for a land war in Europe. We're starting to see some kind of decoupling and breaking at the fringes. That's the first part of this comment. The second part is we have a demographic cliffs that we're hitting in some of these developed countries, meaning we haven't been having the kids at the level that the baby boomer average fertility rate, I think, was around 3.5 to 4 per family. We've in the West been functionally around 1.3 to 1.4. The only reason our populations, that's domestic births, but the only reason our population still grows is because of immigration. And so that kind of world order that we've set up under the U.S. supervision has a geopolitical, constraints kicking in, but also just what happens when you have less consumers. And so that kind of generally, as a view, means that, and this would be my take, is when you have that potential on the horizon, we're going to see more condensing of supply chains more locally. Some of the products and goods that will be we just kind of take for granted now will be more difficultly sourced, and
Mm-hmm.
I think that's going to create some general S&P, Nasdaq, top bulge bracket companies are going to have issues with overexposed supply chains. And so for me, the argument would be is overweight US stuff made in the US generally for US consumers. because we do have the best consumer, and that's just demographic support as well as our
Right.
purchasing powers. So that would be kind of the main macro to answer that question. But then second point, and this is more for the individual at the Gen Z level, is in taking the same vein of that, what I think we're seeing now is the idea of necessarily buying the S&P 500. We're not exactly sure if those trends of 7 to 9% roughly annualized is going to necessarily continue for the next 30, 40 years, because it's based off of a globalized consumption model. And so for our argument would be, if you're a younger person, such as myself and kids younger, is being more concentrated, having fewer positions that you have higher convictions in. That's what's going to outperform the indexes more than just buying the S&P 500. So and that's kind of where I live and the stuff I do, the guys I work with, and that's really what we're focusing on as we transition into the back half of the 2020s. So yeah,
Well,
if that answers your question. I threw a lot
well, yeah,
at you there.
and we're seeing that
Yeah.
perhaps more specifically with China. We
Hmm.
may organically have had a lower fertility rate
Right.
over the years, but in China, it was actually an enforced thing, the one child policy, where they're
Correct.
now seeing a couple things, a perfect
Yeah.
storm of a couple things. With number one, uh, they have a lot more retired and older people than they have
Hmm.
younger people, so they don't have enough younger workers to provide the goods and services that the older generation need.
Right.
And also, the Chinese tend to be more savers than buyers. That you said we're the best consumers of our own goods. China isn't. They're not the best consumer of their own goods. So now they rely. Their economy is based on 2/3 of it is based on exports, selling to
Correct.
consumers outside the country.
Correct.
That's why
Yeah.
we're seeing such a large trade deficit with China, and what Trump's trying to do
Yes.
with tariffs is to sort of equal that out a bit. But we're seeing
Correct.
that, and probably in more than just China and other countries.
You're
Uh,
absolutely right. Yeah.
and supply chains come in when you have um, things manufactured in other countries, then trying to get it to this country. Apple ran into that. Other companies, the supply chain problems, which has caused Apple to react and diversify into other countries like India. But what
Correct.
we see in China, as I understand what you said, is happening in other countries, including our own, right?
Right. So we're not all created. First of all, really good point. And I think I'm not saying China's a paper dragon by any means. They're definitely still a major player on the macro scene, especially military with their buildup. They can produce a lot of issues for the global order in this environment. But real quick comment on the fertility rates. China's one child policy has functionally pushed them down to 1.1 to 1.2, which is lower than our medians. In the U.S., we're about 1.8. So for the Western world, we're really good compared to some of our peers. But yeah, with that being noted, is because they're a communist authoritarian system, there's a bunch of deceit and false data that they're reporting. They were reporting, and we'll use a GDP example. They were saying they were growing at 6 to 8% year over year. Our actual estimates had them closer to 1 to 2. So we know they're lying on their data. They hyper finance everything via their central banks. And not only that, we think there's a potential that they overreported 300 million births over the last 30 years.
Hmm.
Again, they're about 1.4 billion, or so they say. It might be closer to 1.2. The problem is when it's an authoritarian regime like that, the numbers that they're coming out with or reporting are generally not true or accurate and misrepresent. But and this is a key point I think to note is, and it seems minor, but it's super important for this discussion, is Western Europe and us are very much viewed synonymously. Think of kind of like the NATO countries. They stopped repopulating at a replacement's about 2.1. They dropped down to 1.2 to 1.4 starting in like the 1970s.
Hmm.
We slowly have been dropping off the curve. We're at 1.1, 1.8 now, but even 10 years ago we were above 2, or 20 years ago we were above 2. So we have a millennial generation that is twice the size of their millennial generation equivalents. And so that's where it's, yeah, I'm saying we have the best consumer, but we also just have more consumers at peak spending discretionary than our Western counterparts do.
Hmm.
So that'd be the other point that I have on that. But yeah, no, this is really interesting stuff. So yeah, thanks for
And the
talking to me about it.
millennials and the Gen Zs, have you been seeing more and more of them deciding not to have children? That could be contributing also to the lower
Correct.
birth rate, fertility rate.
Yeah, there's a lot of factors to that one. That's it's a really interesting discussion. We can get into it, but it's yeah, why does one not have as many kids? There's a lot of factors into what is the case for that.
Mhm.
Yeah, yeah,
So
it's just
we've seen that the rules, traditional old money rules, don't work for Gen Z. What does work for them?
yeah. So it's a great. Yeah, okay. We're going to talk about all the negative things. Let's talk about some of the positive.
Yeah.
Yeah, I mean, so when we think of life cycle investing, it's a general term. When someone, I mean, historically people say 80-20, is, 80% equities when you're starting out, 20% bonds or fixed
Hmm.
income asset. That's fine. But as someone generally ages and they enter to retirement and post retirement, we see those numbers flip where most of the assets are weighted heavily towards bond and fixed income, and we're weighted off on the equities. So those rules still apply generally. And so in your peak earnings in your late 50s into your 60s,
Hmm.
most of that is going into the bonds, and you keep your equity portfolio. For Gen Z, though, the best asset they have is time. For Gen Z, you have another 35, 40 years starting out of work life experience, of income generating years that I think necessitates taking higher risks. And I think the instincts they have is correct. With that being said, the assets or the instruments that they're purchasing, such as crypto, such as speculative companies that have no real good backing on financials. I mean, the only reason AMC and GameStop really came out the way that they did was because retail came in and saved them in the final year of financial solvency for them. If that didn't happen, those companies probably would have been bankrupt. And so, where I'm arguing, where we need to kind of thread the needle here, is buying companies with good cash flows that are stable, that are US based, US focused generally, and getting concentrated, taking three to five positions of those that we think are going to overperform the index over time. That is where we're going to see some success. So if they're, people listening or talking to, financial advisors, I would be querying them on that. Why are we putting me in, these complicated mutual stock, structures? Yeah, I understand some arguments for the ETFs, but we should be more weight on assets that are going to outperform benchmarks because we have the time, which is the most valuable asset. That's, I think, where we're going to get ahead better than prior generations. And it just, the rules of the road have changed for us than past generations. I mean, obviously hindsight's always looking back, but yeah, right now it's looking not great on the horizon for general global macro trends over the next 10, 20 years, would be my
Well, it's
view.
interesting you
So
mentioned GameStop, because that whole situation with that stock really, I don't want to say broke the model, but you
right,
had all these people saying, "Well, GameStop's going down the tubes," so they start
right,
taking um, short positions.
correct.
Then a bunch of people who are like, "Well, we'll get them," and then through social media and everything else, people started buying the stock,
Yes, yeah, exactly. Yeah,
and people get, they're taking short positions. There's a margin call, they can't meet it, and that sort of buoyed the stock, and maybe that
correct,
may have ultimately saved them,
correct,
because the the market behavior was so counterintuitive. It had nothing
correct.
to do with
Any
company
technical,
performance, any metric. It's just a
yeah,
bunch of people on social media deciding to
correct.
screw over the 1%. They were shorting the stock and kept buying it. So
Yeah,
just a
they short
very
squeeze.
interesting uh,
Yeah,
countercultural phenomenon with
yeah.
that stock.
Well, and while I think, my instincts are that's awesome. And I think that's hilarious. I mean, Melvin Capital, obviously with Ken Griffin and those groups that were running a lot of these short positions. I mean, who doesn't want to see, really rich guys getting burned by, kids on their Robinhood accounts and their, college dorm rooms. I mean, there's something fun about that.
Mhm.
My only cautionary note on that is I think that there's unfortunately been because those events were occurring, because COVID happened at the time that it did, and people know people or they see online, oh look, I turned $50,000 into 2 million doing this thing. Why don't you hop on? We're not getting the educational understanding of how do we, actually look at this environment, and not caging that as, oh, this is a really insane fun moment in time. It's not the norm. And if I were to plug a book right now, I highly recommend Trent Green's Charlie Munger as a really good place to start for some of the thought process on this stuff. Really easy read, not that long, but it kind of gets at the mentality of where some of these early Warren Buffett, early Charlie Munger guys ended up making a lot of the money that they had in the market. And they were taking risks. We talk about Warren Buffett today. Well, buy U.S. large caps and buy Coca-Cola and you'll be, a billionaire like me. That's not really how they did it. If you look at them in the 50s and 60s, deep level concentration, focused on very few securities, and they absolutely crushed the index at that point. So I think we kind of want to get a mentality back to taking those deep concentration convictions, putting our money where our mouth is. And then I think that's where we'll generally outperform, and stay away from the crypto, stay away from the meme stock stuff. As fun as it is, so many more people are getting burned than made money on that. And the few that did, we all want to latch onto it, but it's not realistic for the average,
Yeah.
So,
And a lot of people don't
yeah.
understand how crypto works. And
Yeah.
I've had
Oh my gosh.
an episode a while back on a guy that talked to this. That's what he does with crypto. And he did a
Right.
good way of explaining it, but you start getting into stuff you don't understand and you can really get
Right.
burned. So, if I understand what you're saying correctly, as far as the rules for Gen Z, because they're younger, because they have a higher risk tolerance, because they have some time before they have to
Correct.
retire, then necessarily they should be taking more risks as opposed to just throwing money into an index fund and spreading out the risk and everything else. They should be taking more concentrated positions in individual
Correct.
stocks, things like that, uh, because they have that risk tolerance. But do
Yeah.
they have the knowledge of when to buy, when to sell, and when to hold these individual stocks? Because
Absolutely.
that usually sits with the fund managers.
Right. And this is where you get more into my universe and where I'm at now. And I think where there's this bifurcation that's occurring. The the financial services industry on the macro, they're incentivized for assets under management. What I
Mm-hmm.
mean by that is if I'm a fund manager and I'm charging 1% or 2% a year to manage your assets, I'm not really that concerned about your assets performance. I'm more concerned about how much assets do I have, because that's how many pennies I can take off the dollar each year
Mm-hmm.
to, put in my own, pad my own nest egg, right? If we're talking $100 million, AUM for a manager, he's clearing $2 million a year just keeping you guys in the mix. Not it has nothing to do with your performance. And I think that's where the industry, and I think Gen Z and a lot of people understand this, is that model's somewhat broken. Insofar as if we look at, and the instincts are correct, meaning if we look at the average fund manager, I think 98% of them underperform the index over a 10-year window with fees included, right? Because at the beginning of the decade or beginning of that 10-year window, $1, well, now by the end of it, we're if we're taking a penny off, we only have 90 cents in purchasing power, because each year we're rotating a penny out of it.
Mm-hmm.
And so they just generally underperform the market. So I do think that the place to start would be, as you said, maxing out 401ks, maxing out individual IRAs, rotating into brokerage accounts, getting a little bit of a nest egg kind of above, a 3 to 6 month, kind of cash basket in case you got, fired or let go from work, kind of like your safety net. But above that, there are circles increasingly rising now, and we can, they can follow me on social media for it. We got a few other guys we're getting in the mix on this stuff to basically say, hey, how do we thread the needle between index funds on one side, actively manage that underperforms on the other side? How do we actually try to get ahead that isn't, just so fees focused? So that's, I think, really where we're trying to move the discussion. It's hard. The individual. I mean, if you're working a job, how do you know when to enter and exit positions? How do you know where an intrinsic value kicks in for something you purchased. You don't, and you have a job and you're focused on something else. So yeah, there's more of us kicking in that are trying to fill those gaps. So yeah, it's
Now,
hard.
yeah. So, all right. So we talked about the rules. Now you've talked
Yeah,
about certain markets that you think Gen Z should be capitalizing on, things like defense, energy, and industrial. Tell us about
correct.
that. Those markets, why there's something we should be investing in, and maybe how they can do that.
Right. Yeah. So one, and this is, let me back up. 3 years ago, the market was super focused on ESG, environmentally socially conscious groupings. I'm not exactly sure what it is, but the point is,
Right.
it's
Each company
we're
had a
investing
score.
in. Yeah, exactly. And they're prioritizing, and we're still at that time kind of living under the macro world as we've known it for the last 75 years, which is, okay, we'll generally go wait on for tech companies, generally go wait on for industries that have really good high level financials, and they're just going to continue to do that. You nailed it. It's heavy industrials, defense, and energy are kind of the three ones that I like to focus on because their products and their services are one of two things. They're absolutely necessary. We need to have energy. We need to keep the lights on. We need to move things from here to there. So that's super important. But the other key focus is it's something tangible, meaning it's these are goods and services that we can't do without. And that's really the nexus of it with not to go back to crypto, but some of these more complicated SaaS products, software as a service products, some of these more complicated industries that are, Web3 and obviously now moving into AI. These are layered on services that, yes, while they add value, they are predicated on all the down chain stuff already being in the mix. And my argument is we'll see some decoupling at those heavy industrials, more rotation into defense, more rotation into energy. And I think that's probably where for the next 5 to 20 years, we'll see outperformance when historically US industrials underperformed the market pretty handsomely over the last 40 years. If you're buying an if you're buying the heavy industrial ETF or something, it underperformed the S&P 500. Now I think that's gonna change pretty rapidly. We're
Well,
already starting to see it.
defense and energy makes sense when you think about what do you mean by industrial? And I'm
Heavy
following so
industrial.
far.
Yeah, I got you. Heavy industrial. Think. I'll give you an example. Cleveland Cliffs. It's a hot and cold rolled steel smelting capacity. That steel is required to build infrastructure items. Another heavy industrial would be. I'm trying to think of other. I think of docks and dredging companies that are, and these are things that you almost never see them in your day to day unless you live by a port or a harbor. But there's companies out there dredging the silt out to make sure that the ports are maintained,
Hmm.
things like that. Those would be two good examples. Heavy industrial, think capital intensive. It costs a lot to run these industries. There's a lot of money moving on. They generally have higher debt. To cash ratios than other industries because they're just moving so many things, but they're the
Right.
ones that really build out our the heartland, the American infrastructure that we're going to need to bring back. And this isn't necessarily a push to say, oh, I want to bring American jobs back. We're pro Ohio and building out these areas. My argument isn't political. It's more that it becomes necessary. We might not be able to get as cheaply cold rolled steel out of China, either from tariffs or from import. And so we're going to need to have it. So where are we going to do it? We're going to do it here. And so it's more of a cash flow rotation back as opposed to a political statement, which I think gets lost in the conversation on this, unfortunately. Yeah,
So in
people think it's
looking
political.
to a more intense focus on particular areas, sounds like what you're
Yeah,
saying is these are businesses or industries
yeah,
in the more general sense
right,
where no matter what the economy is, you still need this stuff. When
correct,
consumers start tightening their belts, they're still, they still have to have heat and electricity. They still need gas for their car. They still need these things. These are the things that they're going to cut on other things way before they get to this. So those industries are going to be chugging along and getting their sales and everything else, even in a bad economy, and can be more stable from a risk
they're more
standpoint
stable.
in a good or
They're
bad economy. And
right.
those are the industries that, if you're going to look at individual stocks, those are the ones you should focus on. Am I understanding you correctly?
Correct. Yes, that's a good way of thinking about it. I think another part of this that's just worth noting, and not to overcomplicate it, but someone could easily come back and say, "Well, look at hot and cold rolled steel in the 2008 recession, and look how badly they got beaten up." The argument that I have for something like that is the global macro environment's shifting. Before, when we had a recession, it was our steel was competing on a global market with some subsidization. That now is viewed as a national security interest, and that makes it re-rate higher, and it becomes more expensive because it is not now viewed as a luxury. It's viewed as necessary, and that's really where I think the transition on this is gonna, unfortunately, kind of have to occur. We're not gonna we have to keep the lights on. We have to build new things. We have to have the materials to do so, and we're gonna pay a premium here domestically to know that we can have it, as opposed to openly competing it on the marketplace and not sure if we're gonna get it.
Mm-hmm.
So that's really kind of where the shift is between an '08 crash or even a 2020 mini crash in industrial. We're going to see it might acutely be affected, but generally is going to, if we had another recession, but generally is going to outperform handsomely compared to other industries. So that would be where I'm at with that. So
Okay.
there's a lot of general, NAFTA we can talk about. We can talk about the other treaties that we've set up that have been, harmful to the American working class. But the reality is it's going to have to come back now sooner rather than later. So, yeah.
So, in you, as I understand it, help Gen Z and investors navigate all of what you've talked about.
Yeah.
How do you help folks to do what we've been talking about the last 20 to 30 minutes?
For sure, yeah. So I think the main thing is we're in a word of mouth capacity. What I mean by that is, I get hit up all the time about, hey, can we talk about this? And I'm not quite at the bandwidth, totally capped out, but we're going to get into the point where I think the book and more streamlined on social media might be helpful. I think the hardest part, especially for Gen Z, is to play in some of these circles that we're talking about. Obviously, you can do it yourself individually. The accredited investor rule is very important, and that's where I think, unfortunately, there's a little bit of a divide here, because to be accredited, it's 200 grand a year for the last 2 years, or $1 million net worth, which is a high hurdle for a lot of Gen Z, but that allows access to things like I'm doing currently. And again, I have to do per SEC guideline, right? But as outside of that, email directly. They can email me at jack.f.campbell@gmail.com. And they could also follow me on social media at Jack Campbell Finance on Instagram. I post some stuff there, and they could DM me there as well. So and that's just if there's just general discussions about financial getting in the mix on just general guidelines, because for Gen Z, we're not really getting talked to correctly about this. And I think a lot of people are getting lost in kind of wayward when it comes to the crypto or the meme stock. And I think it's just not good for them. So
Now
yeah,
you're
that's what
working
we're
to
trying to
build
talk.
out a new website, as I see, right?
Yeah,
What
exactly.
is that
So
going to be
we're going to be,
offering, and when do you expect it to be launched?
yeah.
With the
So
understanding that we're recording this on February 10th of 26.
right, yeah. So we'll have it ready in the next couple months for sure. I'm currently tied up with some personal work stuff that we're doing on our end. The other thing just to note on this is this is a we're not pushing products. I'm not, oh, buy this course. I mean, of course, if they want to buy the book, it's kind of where I've consolidated, and that will become released here in a couple months. But really, the thing is, we're not selling courses. We're not selling Uh, get rich quick schemes. We're trying to reintroduce concepts that I think have been lost over the last 50 years when it comes to value investing.
Uh-huh.
And if people are following this and they're making money, and then they want to hit us up when they're accredited, I think that's where kind of the benefit, personal benefit would kick in. But I know a lot of guys who do podcasts, they're in your promoting their you know f- you know social media or whatever. It's like, no, if this is useful for you, by all means reach out. But I mean, we're not selling a course or come to this conference and pay $500, I'll teach you how to do it. It's like we're not doing that. I don't need the money from that. So yeah, so when it comes to following up, yeah, that's pretty much it. It's at Jack Campbell Finance Instagram, or you can email me on the personal, and we can have a discussion. And if you're in a place for accredited for an investor, we can have a conversation down the road. But there really isn't a sale here. We're just trying to get the message out. If things come down the road on this, that's awesome. But I mean, we're not making money doing this by any means. So yeah,
Well, I mentioned when I introduced you, I talked about your upcoming book, Crash Course.
yeah.
Tell us about that, and when it's released, how what can people can get out of that book by reading it.
Yeah, so we walk through kind of the conditions set on the front end of. I mean, it's in Marine Corps fashion. We're maybe a little too direct, but it starts off with you're kind of fucked. Sorry for swearing, but it starts off with Gen Z. You're on the back foot. We
Yeah,
identify what are the problem sets that you're dealing with. How do we prioritize the right things first, which is often debt is one of the main things. Not all debt's created equal, meaning student loan debt is not the same as that 25% credit card debt or that 12% car loan debt, right? And so explaining, quite frankly, what is debt. They're not all created equal. We go into where does asset allocations generally should be supported at, and it kind of walks through kind of like a it is a crash course on how do we get to that outcome of, okay, we actually have some level of financial independence above what the median is, and that's really the goal for this. So it's a kind of a financial 101, if you will, on geared at young 20 something risk on individuals. So yeah, that's really the thought process for it.
all right, great. Well, I
Yeah,
appreciate you coming on the show,
yeah,
Jack,
thanks so much, Steven. I appreciate it.
it's always good to get different perspectives on investing and things like that. The idea of those industries being stable because you're always going to need it. The need's never going to go away, and that's not
Right.
what we're going to cut spending on, really. Certainly, defense, the way the country's been going. So,
Yep.
thanks for coming on the show, giving that perspective. And I'm sure when your book comes out, it'll certainly help a lot of folks.
Heck yeah. Thanks so much, Steven. I appreciate it. Thank you.
All right.